I built an AI to tell me if the economy was going into recession. Oh, fuck. So how did we get here? Well, it may be surprising to some of you, but my background isn't in finance, it's actually in tech. I'm a data engineering manager for a large company. So I thought it would be fun to kind of mix my tech background with my finance hobby, which is YouTube and investing and everything else. So yeah, AI isn't magic. It's basically just a statistical model. So first we need some data points to apply our statistics against. A highly oversimplified explanation is that the model will boil down the statistical correlations we want and then spit out a probability. So the first thing that people probably think of is the stock market. The stock market isn't the economy, but they certainly do tend to crash in a recession. Because in a healthy market, stocks follow a range of price to earnings ratios. In a recession, the economy is contracting, so businesses' earnings go down, and then the stock prices usually follow. Since the earnings go down, the price goes down, so then the price to earnings ratio stays about the same. So let's go ahead and pull in some stock market data. For this, let's do the S&P 500, the Dow Jones, and the Russell 2000. For this, we can use the Yahoo Finance free API, so we'll go ahead and import that. And we also pulled in our Fred API for some stuff we're going to do next. Now, most everyone has heard of the S&P 500 by now, but in case you don't know what it is, it's an index made of the top 500 large cap stocks. That's weighted by market cap, which is simply the stock price times the number of outstanding shares. So if a company issues 100 shares and they're trading at $10 each, the market cap would be $1,000. Now, the crazy tech valuations we're seeing are totally disrupting the balance of the S&P 500. Over half of the allocation of the index is just a handful of companies like Google, Amazon, and Tesla, because these companies have crazy large market caps. So we need to add some balance to ourselves or we're totally going to skew the results. The Dow Jones Industrial Index offers some more variety of large caps from various industries like 3M and Coca-Cola, so it isn't quite as heavily skewed by tech. Finally, we'll throw in the Russell 2000, which is a market cap weighted index of 2,000 small cap stocks. Now, small caps are smaller companies. They're still public, but they don't have the same amount of cash as larger companies. So they're much more volatile, and they're heavily impacted by fluctuations in interest rates. Okay, I guess we need to do the obvious and pull in some actual recession data. For this week, you can use the Federal Reserve Economic Data, or FRED API, which is free. You just go online, make an API key. So we'll just get the series US REC. Then we can go ahead and pull in data for the 2- and 10-year treasuries as well. So this is series GS2 and GS10. The inverted yield curve is a financial phenomenon that occurs when short-term interest rates return higher yields than long-term interest rates. Now, typically, the yield curve is upward sloping because investors expect more risk and thus require higher returns for lending money over a longer period of time. However, when this pattern reverses, it signals something that unusual is happening in the economy. Now, under typical conditions, long-term bonds like the 10-year treasury tend to have higher yields than short-term bonds like the 2-year treasury, because the risks associated with time, such as inflation and uncertainty. So, when the yield curve inverts, it means that short-term interest rates are yielding more than long-term interest rates. And this can happen when the market expects slower economic growth or even a recession. Investors move their money from short-term assets to long-term bonds, driving up the prices of long-term bonds and driving down their yields. The Federal Reserve often raises short-term interest rates to curb inflation or slow down overheating in an economy. If investors believe that these rate hikes will slow the economy too much, or even cause a recession, they might buy long-term bonds, anticipating that rates and yields will fall in the future due to an economic slowdown. Now, the 10 and 2-year Treasury yields are closely watched because their relationships are considered a reliable indicator of economic sentiment. Now, historically, an inversion of the 10-2 yield curve has preceded every U.S. recession in the past several decades, making it one of the most reliable indicators of a recession. Now we'll pull up the SOM rule from the Fed as well. This is SOM real time. Now, this isn't something you hear about every day, but it's one of the most reliable indicators that a recession might be upon us. The SOM rule. It works by tracking the unemployment rate. Specifically, it looks at whether the unemployment rate has risen by 0.5% or more from its lowest point in the past 12 months. So it's really the velocity of unemployment. Why is this significant? Because when more and more people start losing their jobs, it's a clear sign that businesses are struggling, which often leads to a broader economic downturn. Historically, when this rule flashes red, it's been a strong predictor that a recession is either already happening or just around the corner. Think of it like the check engine light on your car. You could ignore it, but you'll be taking a big risk. Speaking of the Fed, their actions arguably have an impact on the economy. Some would even say there's sizable impact. Others would say nothing at all. But anyway, we need to pull in the Fed funds rate as well. So we can pull that from Fred. Now, most mainstream economists agree that the Fed can affect the economy by moving the Fed funds rate. Now, some would argue that they just chase the 2-year Treasury yield around, and they don't actually influence anything tangible, but instead only offer a psychological narrative, but that's a different story for a different video. Anyway, the mechanism the Fed can actually adjust is called the Fed funds rate. Now, the federal funds rate refers to the interest rates that banks charge other institutions for lending excess cash to them from their reserves balances on an overnight basis. Now, theoretically, this should also affect bond yields, which are the real driver of interest rates. For interest, if the overnight rate skyrocketed to 10% and a bond yield at 5%, it would collapse demand for bonds. Because why would banks put money in bonds and earn 5% when they could just earn 10% in the Fed funds? Now, as everyone flocks out of bonds and into the overnights, bond prices would fall, and bond yields are inversely related to bond prices. So if bond prices fell due to plummeting demand, the yields would go up. And this means that theoretically, the bonds and overnight would reach some sort of equilibrium. So, in this example, the Fed's raised interest rates by raising the overnights rates, as it caused bond rates to go up, which would then influence credit. So the opposite is also true. If the Fed lowers overnight rates, this would cause more capital to flow into bonds, which would theoretically drive the yield down. Next, we can pull in the unemployment data from the Fed as well. This is series unrate. This one should be pretty obvious. Unemployment is a key lagging indicator of economic health. A rising unemployment rate can signal a weakening economy and a potential recession. If people aren't working, they can't be productive, which means the economy will start to contract. Less people working means less things get made, and then less things get bought, and less services get used. Next, we'll pull in the CPI data, which is CPI AU CSL or something. CPI measures inflation by tracking changes in prices of a basket of goods and services. High inflation can erode away purchasing power and is often considered when the Fed sets interest rates. The consumer price index is what people typically refer to when they tell you the percentage rate of inflation. So if they say inflation was 4%, that means CPI was 4%. Industrial production is also a really telling indicator. This is IND Pro, PRO. The Industrial Production Index measures the output of the industrial sector, including manufacturing, mining, and utilities. A decline in industrial production can indicate economic slowdown. When people are buying a lot of things, someone needs to make a lot of things. When people are cutting back, retailers, they put in smaller orders. And then the manufacturers don't make as much stuff. It's very simple. So, this can be very recursive as manufacturers lay off workers because there's less orders, there's less people employed to buy things, and then people put in even smaller orders. Then we'll go ahead and pull in GDP data, which is GDP C1. Real gross domestic product represents the total economic output adjusted for inflation. 2 consecutive quarters of negative GDP growth is a traditional indicator of a recession. Although we've seen in recent history that the government decided to just change the definition to gaslight the public into thinking they weren't in a recession, so I guess that means nothing now. Next, we can revisit the 10 and 2 treasuries that we pulled in earlier. We're going to calculate the yield curve by taking the 10-year and subtracting the 2-year from it. Inverted yield curves, when the short-term rates are higher than long-term rates, have historically preceded recessions. In simple terms, typically a longer bond pays a higher yield because you have to lock up your investment for longer. Shorter bonds usually have a lower yield because you don't have to wait as long for maturity. So, when the shorter bonds have higher yields than the longer bonds, it shows that something super out of the ordinary is happening. Once the yield uninverts, a recession usually follows within the next couple of months. Another manufacturing input we should consider is the ISM Manufacturing PMI, which is series NAPM. This is a leading indicator of economic health in the manufacturing sector. Values below 50 indicate contraction, which can be a sign of a recession. The ISM Manufacturing PMI tells a similar story to the Industrial Production Index. Companies create supply to match demand. If people aren't buying things, retailers and wholesalers aren't placing orders. So manufacturers aren't making new things. We should also look at some real estate indicators here too. So we'll go with housing starts, which is HOUST. Housing starts is an indicator that measures the number of new residential construction projects. A decline in housing starts can indicate a slowing economy. Now, this is a leading indicator because it tells you when the housing projects get started. It doesn't take into account whether the projects even ever get finished or whether the finished products get sold or leased. When demand outpaces supply, people build new homes and apartments. This is pretty typical in a growing economy with a growing population. More and more people become adults. When they can afford it, they ditch their roommates or buy a house. Now, when times are tough, people might take out an extra roommate. They might live at home with their parents for a little bit longer or with a friend. Or, stick in a smaller house and wait on upsizing their house. We should also add in consumer sentiment, which is UMC SENT. The Consumer Sentiment Index measures consumer confidence and expectations for the economy. Low consumer sentiment can suggest that the consumers expect an economic downturn. Now, this one should be relatively obvious, but the consumers know best. When companies stop hiring or even start laying off and things are getting way too expensive, people, they notice and they cut back on their spending. They start saving more money and they're more likely to keep their current job in lieu of job hopping. Then we can go ahead and add in non-farm payrolls, which is series PAYEMS. Non-farm payrolls is a critical economic indicator released monthly by the U.S. Bureau of Labor Statistics. It represents the total number of paid U.S. workers of any business, excluding farm employees, government employees, and private households, and employees of nonprofit organizations. Non-farm payrolls are a key barometer to the health of the labor market and the overall economy. Because employment levels drive economic growth through consumer spending and business investment. This indicator has a substantial impact on the financial markets and is closely watched by economists, policymakers, and even investors. rising non-farm payrolls suggest growth and robust job creation. Now, declining non-farm payrolls may indicate a weakening economy or a looming recession. Non-farm payroll data can reveal which sectors are expanding or contracting. It provides insights into how economic events, such as policy changes or geopolitical risks, impact employment across industries. The Federal Reserve and other policymakers use non-farm payrolls to guide monetary policy, including decisions on interest rates and quantitative easing. If non-farm payrolls are growing quickly, it may signal potential inflationary pressures, leading the Fed to consider tightening monetary policy. Non-farm payroll data release typically causes high market volatility, especially in the bond and stock markets, because it directly influences expectations around economic growth and interest rates. Strong job growth may push equity prices up, as it signals economic strength, while bond yields, they may rise in anticipation of rate hikes. Conversely, weak job growth may lead to a sell-off in stocks and a decrease in bond yields, as investors anticipate economic weakening or accommodative monetary policy. Finally, we can grab the personal consumption expenditure, which is PCE, just in case you needed another acronym here. Personal consumption expenditure, PCE, is a key economic indicator that measures the prices of goods and services purchased by consumers in the U.S. It's considered one of the most comprehensive gauges of inflation and consumer spending trends. The PCE is closely monitored by the Federal Reserve and is a critical factor in shaping monetary policy. Because consumers' spending accounts for about 70% of GDP, changes in the PCE provide valuable insights into the health of the economy. The Federal Reserve particularly focuses on the core PCE price index, which excludes food and energy prices, to give a clear view of underlying inflation trends. This index is preferred over the Consumer Price Index, or CPI, because it covers a broader range of expenditures, including items purchased on behalf of households, such as healthcare paid by employers, and it adjusts for the changing consumer behavior. The PCE data is released monthly by the U.S. Bureau of Economic Analysis, the BEA, and is divided into three main categories: durable goods, non-durable goods, and services. Each of these categories reflects different aspects of consumer spending. For example, durable goods include products with a long lifespan, such as cars and appliances, while non-durable goods include food and clothing. Services include spending on healthcare, education, and other activities that don't produce physical goods. The PCE data is crucial because it not only indicates current consumer spending, but it also helps predict future economic activity. Rising PCE values suggest increased consumer demand, which can lead to higher economic growth and potential inflationary pressures. On the other hand, declining PCE may signal weakening consumer confidence and a slowdown in economic activity, possibly foreshadowing a recession. Due to its importance, the Federal Reserve targets a 2% annual increase in the core PCE as a benchmark for stable prices. If core PCE significantly exceeds this target, the Fed may consider tightening monetary policy by raising interest rates to curb inflation. Conversely, if it falls below 2%, the Fed might adopt a more accommodative stance, such as lowering interest rates or using other measures to stimulate the economy. Turn on the money printer. Okay, now that we have a good series of data points, it's time to build a model to train on these data. Let's go. Oh, fuck. All right, so the model says that we're most likely in a recession right now. So, yeah, take it or leave it. I figured, let's see what happens. Let's see what the data says. Figure it's an interesting experiment. Of course, the government changed the definition of a recession anyway, so even if we are in one right now, they could just say we're not, and then we're not. And it doesn't matter how much people are struggling. But anyway, I know this wasn't my normal content, very different. Hopefully you enjoyed it. If so, I can make another tech fusion video in the future. Hopefully it wasn't too boring. So if you did enjoy it, please give me a like, please subscribe so I can keep making content like this for you. And thank you so much. I'll see you next time.